Hey everybody, in this video we're talking about the money market. We're talking about everything you need to know about the money market. And the first thing you need to know about the money market is it also goes by another name called the Liquidity Preference Model. And I do not want you to back away from that kind of sophisticated sounding name. Liquidity Preference Model, it is the key to understanding this graph, okay? What this graph is showing us is our, meaning households, meaning individuals' preference for holding their wealth in liquid form. Liquidity Preference Model. Our preferences, households, individuals' preference of holding their wealth in liquid form, okay? In fact, the curve that shows our preference for holding our wealth in liquid form is the money demand curve. This is the curve that shows our preference for holding our wealth in liquid form. Again, it's a liquidity preference model. Now, let's talk a little bit about your wealth, and we're going to organize it into two categories, of course, okay? We're going to organize it into liquid assets, which is your M1, which is your money, and non-liquid assets. Let me talk about the non-liquid assets first, okay? What are we talking about? We're talking about your home, stocks, bonds, maybe even cryptocurrency, gold, other real estate holdings besides your home, those type of things, okay? The problem, it's not really a problem, but the downside, whatever, of these non-liquid wealth assets is they're not liquid, meaning they cannot be used to buy goods and services, okay? They're not liquid assets. The good side to these wealth assets is they provide a nominal return, and that's key, okay? So what's the positive of these other wealth assets is they provide a positive nominal return. In fact, a nominal return that generally keeps up with inflation if doesn't exceed inflation. Now you might be thinking like, how does your home provide a positive nominal return? It generally, on average, across our country, homes appreciate in value. In fact, the appreciation in value, generally speaking, has kept up or even been better than the inflation rate. Stocks, they appreciate and can provide dividends. Bonds pay interest, okay? And our other wealth assets we talked about, generally, they appreciate in value, okay? Or with the real estate, they can provide rent. M1. Your money, your liquid assets. So remember, there's your liquid and your non-liquid. Your liquid assets is money, it's M1. It's your currency you hold, it's your checking account, it's your savings account. What is the good thing about these? They're in a form or in a near form that can be used, or a form, maybe a bit better way to say it, when I'm thinking about savings account, is a form that you can easily turn into your checking account or move it into your checking account. So it's in a form or a near form that can be used to buy goods and services. It's liquid, okay? So your M1 is liquid. What is the downside to M1? They're going to provide a low or no nominal return. So when you think of your M1, I want you to think of low or no nominal return. Your currency you hold provides no nominal return at all. Checking accounts usually provide very low interest rates, most of them, and savings accounts still generally have lower nominal returns than these other wealth assets, okay? So what is this? It's your liquidity preference model. What is actually showing our preference to holding liquid assets is this money demand curve. There's two components you can see. There's a vertical and a downward sloping. We're going to talk about both. And again, the downside of holding your wealth in liquid form is you're giving up a higher nominal return. The proxy, the stand-in, what we're going to use as our stand-in, it's called like a proxy, just means a stand-in for the nominal return of these other assets is the nominal interest rate. So we have the nominal interest rate right here. That is going to be a stand-in, a proxy for the nominal return of these other wealth assets. So what does that mean? It means that this is the opportunity cost of holding your wealth in money form, okay? What are you giving up when you hold your wealth in money form? You're giving up this higher nominal return that you could have gotten from these other wealth assets, and that's what this is representing, and that's why this is downward sloping, okay? As that nominal interest rate goes down, again, a proxy for the nominal return of other wealth assets goes down, you can see the amount of money that we're going to hold is going to increase. And of course, as that nominal interest rate goes up, as the benefit of holding your wealth in these other forms goes up, you can see we're going to hold less, okay, of our wealth in money form. Now, let's get into this a little bit more, okay? Two sections of our curve. This section, okay, this vertical section right here, which is kind of the base of our money demand curve. This is our demand for holding our wealth in liquid form, i.e. our demand for money to do basic transactions. It's called our transaction demand for money. So what is important about a vertical line is a horizontal distance. So this horizontal distance is our demand for do our basic transactions in life, pay our rent, pay our utility bill, pay our grocery bills, do the things that we have to do to sustain our life, okay, to do our basic transactions. It's vertical because it is not sensitive to the nominal interest rate. We have to hold a certain portion of our wealth as money because we have to, again, pay our utility bill and our rent and those types of things, okay? So this is our transaction demand for money, and conceptually, it is pretty much not sensitive to the nominal interest rate. I like to say, before I pay the utility bill, I've never looked at what the interest rate was before I paid it. I just pay the utility bill, okay? So transaction demand for money. What determines our transaction demand, of course, is not the nominal interest rate. It is the price level, okay, as measured by a price index, okay, and it is the real GDP, which is generally the national income or associated with the national income of the country. So the price level, of course, that affects our transaction demand for money. If prices in general go up out there, we're going to need more money to do those basic transactions. Our utility bill is going to go up, our grocery bill is going to go up, our rent's going to go up. So if the price level goes up, we need more money. So price level goes up, we need more money, so our transaction demand is going to increase, okay? Which is going to push the whole curve to the right, okay? Oops, not the best. Let me take another shot at that again, make it a little bit prettier. So the whole curve is going to shift to the right. So if that transaction demand for money goes up, the whole curve shifts to the right. Same with real GDP or our national income, okay? If our national income or real GDP goes up, we're going to do more transactions, okay? As your income goes up, you generally set up a life that you need more money to do your basic transactions. So national income goes up, we're going to need more money. So an increase in the price level or real GDP / national income is going to increase our money demand. And if the price level or real GDP goes down, we would then shift the money demand to the left. Now, before I move off of that, I just want you to know that if you multiply the price index times real GDP, we're supposed to know that those two things multiplied together, the price index and real GDP, is your nominal GDP. So if a question ever said nominal GDP goes up, okay, no problem. That just means that these two together, or these two together, have gone up, and so we would shift the money demand to the right. There is a couple other things that affect our money demand besides the price level and real GDP, and that would be things like technological advancements like online banking. So if it said there's an increase in online banking, it generally is going to help you out. It's probably going to say decreasing our need for money, which tells you what to do with the money demand curve. So an increase in online banking does decrease our need to hold like cash and things like that. So generally what we would do is we'd shift this to the left. I don't really like that determinant that much. I think it's a little bit awkward of a determinant, but it could show up, but no big deal. If online banking increases, we don't need to hold as much money, and so we would shift this curve to the left. Or if credit card usage goes up, if we use more credit cards, again, we don't need as much money. I don't really want you to focus too much on those. I think the two big ones that I want students to focus on when it comes to money demand, again, are these two, okay? But yes, there's technological advancements like online banking, and there's also things like credit card usage that could affect the curve, but usually they're kind of going to give that away. They'll say an increase in credit card usage causes us to hold less money. Oh, we're going to hold less money? Money demand is going to shift to the left, all right? Next, all right, let's talk about this portion of the money demand curve. It's the sensitive portion, okay, to the nominal interest rate, and it is our desire to hold money above and beyond our need to hold money to do these basic transactions. So take an interest rate like right here. At that interest rate, this distance, just right there, that's our transaction demand for money. But then you can see we're going to hold more money as an asset, okay? And so why would we hold more money than we need to do our basic transactions? For two big reasons, for cushion and speculative reasons. For cushion, we generally like a little bit more money. We want to hold a little bit more of our wealth as M1, just in case something happens in our life that we need more M1, okay? The other one is called speculative reasons, okay? So the idea here is we're holding the asset money in order to buy these other wealth assets. But when are we going to buy these other wealth assets? Well, generally when we get their prices going down, when we get a good bargain to buy them, right? When do we want to buy stocks? We want to buy stocks when they're low. So we hold money sometimes. Some people hold money waiting for a good value on a stock where the stock prices go down. Oh, I can now go buy that stock. That's what we mean by speculative reasons. You're holding the money, just waiting for an opportunity to buy some of these other wealth assets when you get their price going down, okay? So that demand for money, that additional demand for money, besides just doing our basic transactions in our life, is absolutely sensitive to the nominal interest rate. That's why it's downward sloping. Again, that's why when that nominal interest rate goes down and the return of those other wealth assets go down, we're gonna hold more of our wealth as money. And again, when that nominal interest rate goes up, we're gonna hold less of our wealth as money. So there you go. That's the money demand curve. Pretty much everything you need to know about it. It is the curve that shows our preference of holding our wealth in liquid form. The money supply curve, guys, the money supply curve is controlled by the Fed, okay? They are the entity that controls the Fed. If the Fed does something, shift the money supply curve. If the Fed doesn't do something, do not shift the money supply curve. It's that simple. Again, if the Fed does something, you shift the money supply curve. If the Fed doesn't do anything, don't shift the money supply curve. And basically there's two directions you can shift it, right or left. So if the Fed does expansionary monetary policy, you shift this thing to the right. If the Fed, sorry, dropped my lid right there. If the Fed does contractionary monetary policy, shift it to the left. That's all there really is to the money supply curve, okay? If the Fed does something and you're asked to draw the money market, you shift that money supply curve. If the Fed didn't do something and you're asked to draw the money market, then you're not shifting the money supply curve. You must be shifting the money demand curve. That is the main thing to know about this graph, the money market, the liquidity preference model. That's pretty much everything in a nutshell. Hope to see you in the next video.